presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac YouTube update for January the 6th, 2026. Happy New Year everyone. It's a new year and it's a new high for the markets today. So things are looking pretty good. I'll talk about the markets, what happened, what to expect. But first of all, click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Looking at the numbers, markets pulled back a little bit last week, just a little bit of consolidation. But for the year, it was a wonderful year. Last week, we ended up at about nearly 18% gain for the S&P. But the big winner last year was emerging markets. They were up 34%. Why were the emerging markets up so much? Dollar was down a little bit. That did it. NASDAQ was up 21%. That was a good year. And the Dow was also up 15% just about. So a wonderful year in the markets overall, but emerging markets did the best. Why did the emerging markets do so well last year? That's the question a lot of people are asking. I think it's AI. That's going to be one of the emerging markets can really benefit from AI because the education levels are not as high, the research levels are not as high, but they can access now some of the big knowledge bases that are out there just by simply having a phone or simply going on their computers. Just like the internet changed the world, I think the AI is going to change the knowledge base and it can come up with really great changes in the world. So I think emerging markets is something to watch. And they did well. We've been looking at that very carefully. I think it's going to be a place to be. Last week, the biggest gainer was energy, but only 0.9%. The consumer discretionary was down the most, down 2.5% for the week. But for the year, communication services, that's Meta and Google, were up 33%, technology up 24%, but industrials not far behind, up 19.4%. For the year. So it was a great year overall in the markets. Can we get another year like that in 2026? I think it's going to be difficult for the markets. We've had 3 years of double-digit growths in the market. I think the first 5 days is what we have to watch of January. That's how it goes the year. If the first 5 days are positive, usually that is a positive year for the market. So we need to close above 68.45.5. That's where we ended the year. Above that on Thursday. So if you get a close above that, and we're above 100 points above that as of today's close. So if we can get the S&P to close above 68.45.5, that would be positive for 2026. How much? I think 6 to 8%. I'd be happy with that. More than that, like this year, that's just a bonus. But I believe there will be more volatility this year. Markets are expensive. They're not cheap right now. If we do get earnings go up to 310, 315, somewhere around there, even 75, 7,600 for the S&P is expensive. And we have to have great growth in profits to get to that number. So markets are fully valued. Markets, anything, the price for perfection, that's where the markets are right now. Anything goes wrong, geopolitically, something else, who knows? That could create volatility in the market. So you have to be prepared to handle a 10, 15% drop in the S&P. What will that do to your portfolio? Go straight up, everybody's happy, everything is wonderful. What if it does go down? How does your portfolio react to that kind of pullback, that kind of volatility? Can you handle that volatility emotionally? Can you handle that kind of volatility from a financial perspective? That's where you need to figure out, sit down with someone, look at your portfolio, see what it's made of, see what it would do if the market does go down 15. If you go down 30 or 40%, you're in serious trouble when the market only goes down 15. That happens if you're in some of those go-go stocks that drop 20, 30, 40% in those. Oil ended 57.40 last week. It started the year at 72.5, ended at 57.5. That is definitely deflationary. It'll bring in, with the Venezuela, the change of being removed out of office in Venezuela, going to jail, I think Venezuela will be much more cognizant to U.S. demands and what the U.S. needs and opening up the energy sector and taking care of their people. I think that's going to be something that we have to watch and see what happens. Treasuries are about flat. They ended at 4.18. No big change there. There's a Fed meeting at the end of this month. We have the unemployment data coming out at the end of this week, and that's going to be the big data. 60,000 jobs created is the number, is the average guess that everybody's looking for. Looking at cash, it was the worst sector last year. If you were sitting in cash, even though you're getting 4 or 5% on your money markets, oh, look, I'm doing great. You could be in anything else, and you would have done much, much better. That's really the question that you need to ask for, because you get these kind of 3-year cycles that we've just had not that often. I think it's only happened once or twice since 1950, where you get double-digit gains 3 years in a row. And if you miss that, that's a huge amount of money that you're left on the table. And it'll impact your retirement, the way you live in retirement, how much money you have in retirement when you're not earning, and it makes a big difference. Pending home sales up 3.3%. As I mentioned, the big number that we're looking for is the non-farm payroll. 60,000 comes out at the end of this week on Friday. Last month it was 64,000. So not a lot of change expected there. So we'll have to wait and see where we come out on that. And that's really going to tell us if this number is a lot lower than 60K, then we could see some more pressure on the Fed to lower interest rates. Also, we get a decision this month somewhere on the tariffs by the Supreme Court, it's expected. Also, we get a decision on who the next Fed chair is going to be. The president expected to announce that sometime this month. So we'll have to wait and see how those two things impact the market also. Looking at the technicals, still the target is right about here that I'm looking at somewhere. So we're here right now. We can get up to 71.5 to 71.75, somewhere there. If we go right through it, then we'll have to this area. But that is the projection for the high that I've been mentioning for the last couple of months, somewhere around 71.5. After that, we'll have to wait and see. I expect market to sort of go sideways, maybe pull back a little bit, because on a weekly basis, we're fully priced. But the target comes in somewhere around here, around 72.5 to 7,300, if we can get above 71.5. NASDAQ, same thing, target is here, or the fifth wave, which is around 25.5, is what we're looking at right here. So 25,500, we're at about 23,500 today. So another 2,000 points for the S&P. We could get, on the NASDAQ, could get another 5-6% before we top out. Looking at the high yield sticks, still stuck in this range of about 4.2, right around 4%. That's where we've been. A bigger range is right here to about right here, 4.5, 4.6. I think in the short term, we're just going to bounce around here, stay in this range. Gold looks good, but again, it's gone up a lot. We gapped up here, gapped up here, gapped up here. So we've got a lot of gaps here. Still, looking good, but I think we are looking at a fifth wave top, and that is usually the end of the move. But silver looks a lot better, as I mentioned, the last couple of months. It has done better, but I might be looking to take some profits in gold and silver if you were there. High yield bonds seem to be trying to break out, and we're in this tight range. Broke out of there yesterday and today. We can get above here, 81. That would be very positive. Breakout above here, and that would indicate that the economy is really taking off on the upside. That's the way I'm looking at the markets today. Again, if you'd like to subscribe to this channel, click on that subscribe button. Also, if you need help with your portfolio, need to see how you did last year, prepare for 2026, send us an email at invest@compact.com or give us a call at 800-388-9700. Those are my thoughts. Those are what I'm looking at for this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.